Let's ask the community.
Hey, Equity
Hi,
Mate.
I just had a question.
Hey, Bryce, I've got a question.
Answered.
This week's question comes from Troy Patterson, and Troy asks, guys, what are some long-term stocks and sectors for me to look at for my newborn's shares portfolio that he wants to start for him? So, Ren, where do we want to start with this one?
Yes, so I think if you're thinking about a newborn's share portfolio and you're thinking about their 60 or 70-year time horizon,
Yes.
I would argue that it actually
Gee,
doesn't...
you'd be a rough dad not giving it to your kid until they're 70?
Well, I mean, okay, so if you're thinking about investing for them and giving it to them when they're an adult, so like a 20-year time horizon, or if you're thinking about it, setting them up for long-term, 60 years, I actually don't think it differs too much from someone in their 20s or 30s thinking about a 30-year, 40-year time horizon. Because it's not, we talk about different assets being suitable for different time horizons. We talk about, in the very short term, sort of 1 year, you want to be invested in cash, high interest cash, nothing more. You blow it out to sort of 2 to 3 years, you start looking at your fixed income options. You go to 5 to 7 years, you start looking at stocks. It's not like there's an asset that's most suited for like a 20-year time horizon or a 50-year time horizon. We've covered all the assets at that point. And so the answer that we give is going to be pretty similar to an answer that we give for someone in their 20s thinking about investing for retirement, with a really important caveat that the risk is actually higher as you blow your time horizon out, just because there's more uncertainty and more things change. So for me, it's not like there's new assets and new opportunities for growth. It's actually you want to build the portfolio to be more resilient because it's going to be tested more.
Yeah.
So that's probably my starting point.
So with that said, let's get into the nitty-gritty. The most obvious answer when you're thinking about what to put in a portfolio for a pretty extensive time horizon is index ETFs.
Yes.
We've spoken about it time and time again. We're talking low-cost, diversified, global index ETFs. Specifically, you've got the ASX 200, which is the market here in Australia. You'd be looking at the S&P 500, the market over in the US. You could make a portfolio of some of the major markets around the world, the FTSE, for example, or you could take those ETFs that are set up to give you global access in one hit. For example, the MSCI All World Index. I think it's 1,500 companies spread across all major indexes.
Now, why the index ETF is the obvious, but I would argue the right answer, is also it's a product that is set up to be truly long-term. The way that it rebalances every quarter, you cut your losers, you add more of your winners, it means that it is a product that is, in theory, meant to last for an infinitely long time, just continually rebalancing every quarter. So the risk of the index going away is close to zero. Indexes have gone away historically, but we're talking like the Russian Revolution in 1917 shutting the stock market down. Like that's the kind of historical event that would have to happen. As long as the Australian stock market exists, the ASX 200 in theory should exist. So when we're thinking about, like being really resilient, an index is a product that is designed to be resilient and to move with the changing tides of the stock market. So that's why it makes sense from a growth perspective, but also from a resilience point of view if you're thinking really long term. So that's the obvious answer. Let's move to individual stocks because that's really, I think, where the question was directing. For me, don't worry about growth. And we'll get into that. But for me, if you're thinking about individual stocks for a very long time horizon for your newborn, moat becomes the name of the game. Sustainable, defendable competitive advantage that means your business will be there in the future. Because my guess is more than half of the ASX 200 stocks won't be in the ASX 200 in 60 years. They'll go bankrupt, they'll get bought out, they'll just decline because they'll get disrupted. And to prove that out, I found the top 10 of the ASX from 1968.
Nice.
So that's 56 years ago. Tell me how many of these companies you recognize. Top of the list, the just undisputed king of Australian stock market returns, BHP.
Yeah, crazy that it's still there.
In 1968, it had a market cap of $3 million.
Wow.
Yeah.
Wow. Phenomenal.
But after that, North Broken Hill, Conzinc Rio Tinto, heard of it, Hammersley, MIM, Western Mining Corp, CSR, Maya, New Broken Hill Corp, Ampol.
Wow.
So some of those names familiar. BHP, Rio Tinto, Maya, Ampol. So, if you'd bought those companies, you'd be okay. But a lot of the other ones have been merged or will have gone out of business or things would have happened.
Yeah, you would have had to have bought, or if you'd even missed one of them, you're in a bit of trouble.
Yeah. I would be arguing if you're looking at the ASX 200 today, forget growth. Focus on resilience if you're thinking about a 60-year time horizon. I'm going to stick to this 60 years because if we're saying 20 years,
Same thing.
Yeah. Without wanting to give individual names, where I'd be erring is like a BHP, a Woolworths, maybe a Commonwealth Bank. Like for me, they're the ones that are going to be there.
They're not going anywhere.
Like even Telstra for me, Telstra might not be there in 60 years. Like
Wow.
how we deliver phone and internet connectivity is going to radically change.
Yeah.
But how we buy groceries is probably going to change less.
Yeah. They might still be there, in my opinion, but they might be chronically underperforming.
Yeah.
Which is why the beauty of the index product, again, comes into play.
Yeah.
You don't have to choose the top 10 stocks that you think are going to be there in 60 years.
Yeah.
And the best ones that are going to perform over this next 60 years are going to be the ones that are at the top of the index.
Yeah. The index is just a better designed product for a super long time horizon. It is. And, if you had bought the ASX 200 in 1968, it didn't even exist then as an index. But if you had bought it then, you would have been better off unless you just nailed your stock picking.
You have to be super active.
But what I said earlier was what you want to avoid is growth stocks. And because the thinking, there can be a little bit of a growth trap in some ways. It can be like, I'm thinking about a 30-year, 40-year, 50-year time horizon. So I can buy the growth stocks because they're going to do well. And you might be right, but the challenge is too many of them will fall off.
Yeah.
Like growth stocks just have a question of, are they truly viable long term?
Yeah.
And for every Apple and Microsoft that does become truly viable long term, there's a long list of quote unquote growth stocks that didn't make it into the long-term viable category.
Yeah.
The ones that I'm thinking about today, that I would be questioning what they would look like in 60 years. Like Nvidia, Tesla. Like maybe they do it. Maybe they are sustainably profitable, but maybe they get disrupted.
But there's also a huge tier of growth stocks that are below those mega caps that are probably even more likely to not be around than Nvidia and Tesla. Like those a lot of the SaaS businesses, ones that we don't really hear of that are churning out incredible revenue growth at the moment.
Snowflake,
But
Datadog, all that stuff.
Where are they in 60 years? Yeah.
I think we've made the individual stocks point. So let's turn to another category of assets that we'd probably avoid, thematic ETFs.
Yeah, so thematic ETFs, again, I think you can fall into a similar trap, thinking that over the long term, hydrogen or battery and storage technology, it's going to play out. It's a huge long-term trend. But again, the companies within that, they're not built for resilience. They're built for taking opportunity with a thematic that is playing out in a much shorter time horizon. And you have no idea where that thematic is going to be in 60 years. You're essentially taking a bet that the best performing thematic would be battery and lithium technology.
Yeah.
So
let's make the classic example of hydrogen. I think it is a reasonable thesis to say that 60 years from now, the world will be consuming more hydrogen than it is today. But that shouldn't lead you to say, all right, well, I'm going to buy a hydrogen ETF for my child and things will be good, because the cost to produce hydrogen, who is producing it, and are they in the hydrogen ETF? There's so much uncertainty that for me the thematic ETFs are not the right product for that time horizon. They're the right product for more tactical, closely watched investments.
Yeah.
So Our conclusion, that is a
Yes.
long way of saying a pretty boring answer, that if you're truly thinking long term, you want to minimize uncertainty, the product that is most certain to still be there are these index products because of the way they are designed. So the easy answer, in our opinion, may be the best answer, and that is start investing for your kid early and dollar cost average into index ETFs.
Love it. And if anyone asks us about what we should do with kids, we're going to clip this up and put it on YouTube and put it on our Instagram, and then we're just going to send the link to everyone. 'Cause
Yeah.
that is that's the crux of it.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.